Ever wondered how cryptocurrency works? Don't worry, you're not alone. The world of cryptocurrency can seem like an alien landscape, but it's a lot simpler than you might think. At its core, cryptocurrency is a form of digital or virtual currency that uses cryptography for security. Yes, we're talking about the same kind of cryptography that keeps your online banking secure and your emails private. Now, unlike traditional forms of money, which are issued and regulated by central banks, cryptocurrency operates on a system of decentralization. You can think of it as a democratic form of currency. There's no central authority, no government oversight. Instead, transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. This is what gives cryptocurrency its unique edge and has made it a hot topic in the world of finance and beyond. The first and most well-known cryptocurrency is Bitcoin, which emerged back in 2009. Since then, thousands of different cryptocurrencies have been created, each with its own unique features and uses. Ethereum, for instance, is another popular one, known for its smart contracts and decentralized applications. But what do we mean when we say decentralized? Well, in the world of cryptocurrency, decentralization means that transactions occur directly between users without an intermediary, like a bank or a government. This decentralization is possible because of the technology underpinning cryptocurrencies, the blockchain, which we'll delve into more in the next scene. Another key feature of cryptocurrency is its security. Thanks to the magic of cryptography, transactions are incredibly secure. Each transaction is linked to a set of complex mathematical problems, and these problems must be solved in order to verify and record the transaction. This process is known as a mining, and it's a vital part of the cryptocurrency ecosystem. Cryptocurrency, in essence, is digital money that uses cryptography for security. But how does it work? Let's dive in. To grasp the concept of cryptocurrency, you first need to understand blockchain technology. Picture a digital ledger, a kind of high-tech virtual notebook where every single transaction is recorded. This is the basic essence of a blockchain. But unlike your everyday notebook, this one is decentralized and resides on numerous computers known as nodes all around the world. Now think about the last time you made a transaction. Maybe you bought a cup of coffee or a pair of shoes online. That transaction was recorded in a central database controlled by a bank or a credit card company. With blockchain, there's no central authority. Instead, each transaction is recorded on this global decentralized ledger. Here's where it gets interesting. Each transaction is grouped with others in a block. Once a block is filled with transactions, it's added to a chain of previous blocks, hence the name blockchain. Each block is like a page of our notebook, and the chain is the spine holding it all together. Now you might be wondering, what's so great about a blockchain? Well, two words, transparency and security. Because the blockchain is decentralized and each transaction is recorded across numerous nodes, it's nearly impossible to alter or delete a transaction once it's been added to the chain. It's like writing in permanent marker on a page that millions of people hold copies of. This transparency also means that anyone can view the transactions, fostering an environment of trust. You don't have to rely on a bank or a credit card company to tell you if a transaction is legitimate. You can see it for yourself on the blockchain. And let's not forget about security. Each block is secured using complex mathematical problems that only a computer can solve. This process, known as mining, makes it incredibly difficult for hackers to tamper with the information, so blockchain is the backbone of cryptocurrency, providing a secure and transparent way to record transactions. But how does a transaction work? A cryptocurrency transaction might seem complex, but it's quite straightforward. Let's break it down. Imagine you've got some digital coins in your crypto wallet, and you want to send a portion to a friend. The process begins when you sign off on this transaction using your private key. Think of your private key as your unique digital signature, something that proves you are the rightful owner of the coins you're about to send. It's a bit like signing a check, but far more secure. This private key should be kept secret, as anyone who gets it could potentially gain access to your cryptocurrency. Now, your friend's public key comes into play. This is essentially their crypto address, a bit like a bank account number, but for the digital world. You use this public key to specify where you're sending your coins. Once you've signed the transaction with your private key and identified your friend's public key, the transaction is broadcasted to the network. This is where the concept of mining comes in. Mining is not about pickaxes and hard hats, but about powerful computers solving complex mathematical problems. These problems are essentially the transactions waiting to be validated. Once a miner solves the problem, the transaction gets added to the blockchain, the public ledger we talked about in the previous scene. This process of validating transactions and adding them to the blockchain is what creates new coins. However, it's important to remember that the number of new coins created through mining decreases over time. This is due to an inbuilt mechanism in cryptocurrencies like Bitcoin, which halves the reward for mining every 4 years, a process known as halving. This scarcity is one of the factors that can drive the value of cryptocurrencies. So, transactions are securely recorded on the blockchain, and miners validate these transactions. But what makes cryptocurrency valuable? Stick around and we'll delve into the value of cryptocurrency in the next scene. People often wonder why cryptocurrencies like Bitcoin have value. Well, let's dive into it. The value of cryptocurrency is not backed by physical assets or guaranteed by a government. Instead, its worth is determined by factors such as supply and demand, utility, and the cost of production, also known as mining. Now let's start with supply and demand. Cryptocurrencies like Bitcoin have a finite supply. There will only ever be 21 million Bitcoins. This scarcity drives up the value as demand increases. It's the classic economic principle. When supply is limited and demand is high, the price goes up. Now, let's talk about utility. The utility of a cryptocurrency is its usefulness and versatility. For example, Bitcoin can be used for online transactions, stored as an investment, or even used for remittances. The more versatile and useful a cryptocurrency is, the more demand it generates, which in turn increases its value. Finally, we have the cost of production or mining. Mining is the process of validating transactions on the blockchain, and miners are rewarded with new coins. This process requires significant computational power and energy, contributing to the coin's value. The more expensive it is to mine a coin, the more valuable it becomes. To sum it up, the value of a cryptocurrency is not arbitrary. It's determined by real factors like supply and demand, utility, and the cost of production. This is why, despite the volatility and risk, many believe in the potential of cryptocurrencies. The world of cryptocurrency is fascinating and complex. It's a digital gold rush, a new frontier of finance. And just like the gold rushes of the past, it's the bold, the innovative, and the visionaries who stand to benefit the most. The value of cryptocurrency is determined by various factors, mainly supply and demand. But how can you get your hands on some? This question takes us to our next topic, investing in cryptocurrency. Stay tuned to learn more. Investing in cryptocurrency can be a great way to diversify your portfolio. But how do you actually go about it? Well, the first step is to buy cryptocurrency on an exchange. Think of it as a digital marketplace where you can trade your traditional currency for cryptocurrency. There are numerous exchanges out there, each with its own set of features, fees, and supported currencies. It's important to choose one that fits your needs and to ensure it's reputable and secure. Once you've chosen an exchange and bought your cryptocurrency, you'll need somewhere to store it. This is where a digital wallet comes in. Your digital wallet is like your personal bank account for your cryptocurrency. It allows you to send, receive, and store your coins securely. There are different types of wallets, including online, mobile, desktop, and hardware wallets. Each has its own strengths and weaknesses, so consider your needs and level of security required when choosing. Now, before you dive headfirst into the world of cryptocurrency, it's crucial to do thorough research. Cryptocurrencies are highly volatile, meaning their value can fluctuate wildly in a short span of time. This can lead to high rewards, but also high risks. So it's wise to stay informed about market trends. Understand the technology behind the cryptocurrency you're interested in, and be aware of any potential risks. And remember, just like with any investment, it's vital to invest responsibly. Don't invest more than you can afford to lose. Diversification is key. Don't put all your eggs in one basket. Consider your financial goals, risk tolerance, and investment timeline. when deciding how much to invest in cryptocurrency? Remember, the world of cryptocurrency can be exciting, but it's essential to do your research and invest responsibly. Now, you have a basic understanding of cryptocurrency and blockchain. Happy investing!